The market drop could be a huge opportunity to find the gaps in your portfolio and pick up stocks on the cheap. In this video, I'm sharing my own portfolio to show you how I find stocks I need to add. Then I'll compare 6 stocks across 10 different factors to pick my 3 favorite dividend stocks to buy in March. We're talking best stocks to buy today on Let's Talk Money. Beat debt, make money, make your money work for you. Creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, we recently launched our investing spreadsheet and did that live stream of portfolio reviews. We used the spreadsheet for that big picture view of your portfolio, where the risks are and the gaps that you need to fill. And I realized I haven't yet used that to find the gaps in my own portfolio. So updating our 2020 Dividend Challenge portfolio with March stocks to buy, I wanted to take this opportunity to dig in there and see where I need to boost my own portfolio for safety and returns. In this video, I'll show you my entire portfolio. We'll look at finding the gaps in asset classes and sectors. Then I'm going to use the stock comparison tool to pick 3 stocks to buy right now. And if you haven't checked out that spreadsheet yet, I've left a link to the download page in the description below. I worked with developers for 3 months putting this thing together, and I love how it turned out. Not only can you track your portfolio and find those risks, but it's a complete retirement planner and stock comparison resource as well. So I've already entered my stocks and funds here in the portfolio tab. And remember, all you need to do is enter in the ticker symbol, the number of shares you own, and the average price paid per share, and then click this load data. Now the spreadsheet will fill in all this other data automatically, and you'll be able to double check to make sure it pulled in the asset class and sector for each. For example, if you get to some of these REITs, then it's sometimes not going to pull in that asset class. So you just change these, you click on here and change these to the real estate asset, as well as for some of your bonds. So the bond portfolio, BSV, Vanguard short-term bond portfolio here, had to change this to asset class. Now a note here, because we've had some questions from users, the spreadsheet right now is only set up for US listed stocks, ETFs, and ADRs, so anything that trades in the US. I'm going to be updating the spreadsheet with Canadian stocks and funds as well as adding some other features, but we're not there yet. So I've got 10 funds here and 32 stocks, which is honestly way too many. Being an analyst and making these stock picking videos, I'm no less susceptible to that shiny object syndrome, and I tend to add a lot of the stocks that we talk about on the channel. Anyway, we have the data for stocks, and we can scroll over to see everything that this stock spreadsheet is going to pull over. It's going to pull in current price, the name of the company, its sector, industry, market cap, dividend yield, all this data, this beta, which is going to be very important when you're looking at that portfolio view, price to earnings, your current portfolio value, and then this percentage of portfolio. And I love this feature because it can save you from chasing a stock down, dollar cost averaging until it's 20 or 30% of your portfolio, and really wiping out your nest egg. So we see how much each fund and stock is as a percentage of my portfolio here, and there are a few warning signs. So this color-coded index is going to show you green when a stock is less than 3% of the portfolio, and that's most of the stocks here. It's going to switch to yellow if a stock is 3 to 5%, and then pink if it's something between 5 and 10% of the portfolio. Now, what you really want to watch out for is these stocks that make up more than 10% of your portfolio, and you'll see those in red here. It looks like I don't have any in red here, but do have a few approaching that point, and I wouldn't want to add money to these if I want to keep my risk lower. Then we can check the portfolio overview tab, and the first thing you'll see is this asset class breakdown. So what percentage of your portfolio do you have in stocks, bonds, and real estate? Now another update we're coming out with is the ability to add cash and some of these other non-stock investments, so it's going to show everything here. For example, this doesn't include my cash position, my P2P investments, investing in startup companies, or direct real estate properties. But I'm pretty happy with these percentages here with 10% in bonds and 13% in real estate, not counting those other assets. Scrolling down in the sectors is where I really see the gaps I didn't realize. Here I can compare the percentage of my portfolio in each sector against the sector weights in the S&P 500. And I can see I'm underexposed here to communication services, consumers, healthcare, energy, and utilities. Now I'm a little worried about the consumer on that coronavirus scare and some of the cyclical sectors for the same reason. I do want more exposure to the utilities for that dividend yield and market protection. After Super Tuesday, I'm more comfortable looking at the healthcare companies, and those demographic forces for that sector are really pointing in the right direction. Nation, one question has pretty much dominated my thinking over the last week. What investments are going to do the best in that zero interest rate environment? The Fed made that emergency cut earlier in the week, and both the 10-year and the 30-year treasuries have hit all-time lows, with the 10-year rate falling below 1%. This would have been unthinkable a year ago, that the US could follow Japan and Europe into zero or negative interest rates, but now with most of the market expecting at least another 2 cuts from the Fed this year, that could take the 10-year treasury to just 0.25% or less. And I know this sounds like a great idea, cheap money and near zero interest rates, but it's not all rainbows and unicorns. Banks just can't make money with that long-term rates next to nothing. Instead of taking the risk to earn nothing, they just sit on their money, and this is something that we've seen in both Europe and Japan. The banks just don't lend. So in this kind of environment, the financial stocks just suck. A sluggish economy pulls most of the cyclical stocks lower as well. Bonds do relatively well while rates are coming down, but then pretty much stagnate. Really, the only investments you can count on here are those safe dividend-paying sectors like utilities, telecom, and maybe gold. So we're going to go back to the spreadsheet into the stock comparison tab, and I'm going to compare 2 companies in 3 sectors here: utilities, healthcare, and energy. Now, I like utilities for that dividend play, and I think healthcare will also provide some of that safety and growth. While I think energy could see more weakness on the economy, I like the value play here and could use a little bit more exposure in my portfolio. So our first 2 stocks we'll compare are Dominion Energy, ticker D, and Exelon, ticker EXC. Now if I click this compare button, the spreadsheet is going to pull that data for those 10 fundamental measures as well as the average for the sector. Now, I really like being able to compare each of these against each other, but also against the sector to make sure I'm investing only in the best stocks in the group. And we see that both are trading under the sector average for price to earnings ratio, though Dominion is a little bit cheaper. Down here to the profitability margins, Dominion is dominating on these with a gross margin of 39% versus just 14% for Exelon. Now this operating margin is obviously wrong, and a problem we've been having with that website, Financial Modeling Prep, where we're pulling this data in from the internet. But the profit margin number backs this up. Dominion is just much more profitable, and both these margins are well above the sector average. Now Dominion has a higher debt to equity ratio than Exelon, but it's still well below the sector, and a 5% dividend yield is excellent. I'd be a little worried about that payout ratio at 89%. So the company is paying out 89% of earnings to cover the dividend versus just 66% for Exelon. Now that might mean dividend growth for Dominion might not be as high in the near term, but it's already at 5%, so that's fine by me. 10 analysts have price targets for Dominion, with one as low as $40 a share, though most are grouped right around that $80 to $85 per share value. Earnings are expected higher by 3.3% over the next year, so maybe a little price appreciation beyond that dividend and that safety in utilities. For our healthcare stocks, I pulled 2 dividend picks from our sector series where we looked at the 5 best stocks in each sector. So here I'm going to look at Gilead Sciences, ticker GILD, and United Health Group, ticker UNH, and then click the compare button. Now here it's not exactly an apples to apples comparison since these 2 are in different industries, pharmaceuticals versus health insurance, but both are solid companies and I just want to let the numbers decide. So here Gilead has a clear advantage in the valuation with 15 times PE ratio against that 20 times for United Health. Gilead's focus on HIV and hepatitis drugs, 2 of the highest profit margins for drug makers, means it also has the lead here in these profit margins. Where Gilead falls behind is in this higher debt to equity ratio and a higher payout ratio, though I'm not sure I'd even consider United Health a dividend stock with just a 1% yield. Analyst price targets for Gilead range from $60 on the low side to $86 per share over the next year, though earnings are expected slightly lower. Now for our energy play, I wanted to be in the largest and most established majors. The sector is really struggling, and even a cut by OPEC may not be enough to stabilize prices. So if I'm adding names, I want to be in a company with a strong balance sheet and the financial flexibility to survive until prices rebound. So here we're comparing ExxonMobil, ticker XOM, and then BP, and their price to earnings are pretty close, though Exxon has a much lower price to sales ratio, so a better value on that measure. The profitability metrics are higher for Exxon, though they're both below the sector average, so I probably want to also look at that and maybe try finding some more profitable companies. Now Exxon's debt to equity ratio is much lower, and even though the dividend yield is lower, the payout ratio for BP doesn't leave a whole lot of room for growth. Analysts have price targets for Exxon from $56 a share to $99, and earnings are expected 37% higher over the next 4 quarters compared to the last. At the current price to earnings, I would expect any earnings growth to be a major boost to the shares, and I really like this one over the next year or 2. Click on the video to the right for my 5 favorite tech stocks to buy right now. 5 companies that could change the world and your wallet. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.